On today's Hot Sheet, I'm discussing the fading lock-in effect, record high down payments, and weekly unemployment. Today is Thursday, August 29th, 2024. I'm Byron Lazine, and the Hot Sheet starts now. August 29th. Wow. Where has the time gone? Of course, we're coming into Labor Day weekend here, which means we will not have the Hot Sheet on Monday. So just a little bit of housekeeping there. Of course, we do this show every Monday through Thursday that the markets are open. So when there is a Monday holiday, typically when the stock markets are not open, the Hot Sheet will not be open. We'll be back on Tuesday, of course, outside any crazy weekend breaking news or something like that, which I don't anticipate here over Labor Day weekend. But with the past year in real estate, you never know what could happen. All right. Let's get into what we've got here on the docket today. A little bit of a slower day as we, again, are going into this Labor Day weekend. But some interesting data on this lock-in effect, the Cold War of real estate, as I called it quite some time ago, before lock-in effect kind of took over and became the word choice of use. Right now, Redfin is reporting that 6 of 7 people with mortgages have an interest rate below 6%. But they also say the lock-in effect is starting to ease. Of course, the lock-in effect is preventing homeowners who would be buyers and sellers, because they sell to go buy, from entering the market, which is also creating a lack of inventory, relatively speaking. We know we've been on an inventory growth trajectory all year. We're 40% above the same point now that we were last year nationally, according to Altos. And even new listings are improved from last year. But of course, anything could be improved from last year when it comes to new listings, because that was the lowest level ever recorded. The lock-in effect is impacting all of these variables, new listings and inventory. People are deciding, hey, if I've got a 4%, a 3.5%, some of you all know, and maybe some of you even have 2.75% 30-year fixed interest rates, it's hard to move. It's easier to say, hey, I'm going to go ahead and make this house work now, or this home, a little bit bigger or whatever. Now, I expected to see that in the results from Lowe's and Home Depot. Been saying that over the last year. Now we know that Lowe's and Home Depot are both projected to slow down in the second half of this year. So you're likely to see less of that. And as these rates come down, hopefully we will see more of this inventory enter the market and get a more fluid marketplace, right? We're at 3.95 million existing home sales today, according to NAR, seasonally adjusted. 4 million is the floor. And we've never seen this low of levels when you calculate where we're at with population and so on. Okay. But Redfin is now saying that this lock-in effect is slowly easing, because eventually people have to move. Okay. Eventually people just get fed up and they say, you know what? The rate's at 6. It's not 8 anymore. Right. I think we could do that. We're at 3, but we're going to be trading up for 6, but we're going to get the lifestyle that we want. We're going to put our family in the situation that we want to be in. Eventually, as kids get older, or whatever the case may be, oh man, they're already 7, they're already 38, 39. People are like, I just got to get into the spot closer to the school that we want to be before high school. Eventually, people make decisions that are based on the rest of their life, not the current situation or the current interest rate. Being happier, okay? Living where they want to be, being around the right family structure, the right education structure, the right community structure. Eventually, people make those decisions. They just get sick of waiting for the affordability to work out perfectly in their favor. They might give up a little bit more to have kind of what they want in their home life. Okay. Nationwide right now, 85.7% of homeowners with mortgages have a rate below 6%. Still a lot, but that is down from 90% to start the last year. And there's a record high number of 92.8 in mid 2022. So not in 2022, 93% of homeowners with a mortgage, remember, about 40% of homeowners do not have a mortgage. But 93% of those 60 that do in 22 were under 6%. Now that number is 85. Okay. So it's moved down. Still a big number. Okay. So even more than 85% of homeowners with mortgages have rates below the current weekly average of 6.46, right? So that's probably closer to 90 or somewhere between 86 and 90 anyways. And that prompts them obviously to stay put instead of selling and buying that other home. That's the lock-in effect. Here's the chart as it looks today. Okay. For those wondering or that have consumers wondering, this is a pretty unique piece of data. Nearly 9 in 10 mortgage holders have a rate below 6%. Look at the number below 3%. It's never been bigger. Okay. It's crazy to see. People would laugh if they said, oh, I'm going to get a 30-year fixed below 3% one day. It seemed inconceivable for decades that you would get a mortgage at 2.5%. Look at the next category, 3 to 4%. You're up over 50% still today that have a rate under 4%. Under 5%, that number's at 75% when you look at under 5% rates. That's where I really think getting to 5% on the 30-year fix opens up a lot of this inventory. Okay. It starts because if you're at 3.5 to 5, that's not as big of a jump as 3.5 all the way to, 6.5, right? And we're below 6.5 today, by the way. Good news on the 30-year fixed yesterday. So here's the numbers in exact form: 85.7 below 6, 76.1 below 5, 57.4 below 4. So I think I said over 50, but 57.4, almost 60% are below 4. And then 22% are below 3. It's a huge number. But again, Redfin has started to see those trends, and you can see them on that chart. They're starting to slowly loosen up. Now, some of this has to do with the last couple of years, more buyers coming into the market at 6.5, at 7, at 7.5, even at 8 at times. And we saw those 10 locations. I think we covered that last week. If I go back, when was that? Was that last week? That was definitely last week. So if I go back to last week's show, which day was that? If I go to last Wednesday, August the 21st, okay, and I'll open this up for you guys just as for those that missed it. This was a Realtor.com study. There are 10 places where the lower mortgage rates will unlock housing the fastest. Okay, here are locations where you actually have a share of mortgage rates above 6.5%. Naples, Florida, where I'm sitting right now. 15.2% of the mortgages are above 6.5. St. Louis, Myrtle Beach, Cape Coral, Miami, Albuquerque, Kansas City, Fort Wayne, OKC, and New Haven. These are opportunities for investors. These are opportunities for agents to call on these homeowners and see if there's something that they want to do with that property. Okay. For those that are above that higher interest rate, they're more likely to say, hey, this ain't the right house, or I want to sell it, or I want to offload it, or I want to do something with it. You can find out where the mortgages are. We use a PropStream. We have a link with BAM with PropStream. You can check that out if you're interested in trying to target specific mortgage rate categories in your market. Use a resource like PropStream. We'll put if Haley could put that link in. Oh, there it is. She's got it. Great. Good work, Haley. Bobby would have been at least 30 seconds behind. Just throwing that out there. Hopefully Bobby will listen to that. So there you go. We've got the lock-in effect easing up. If you get the rate, we talked about it yesterday with Wells Fargo's projection, right? If you get that rate down to 5.9 by Q2, okay, and we're not far off from there. Look at where we ended up yesterday on the 30-year fixed. Okay, we've been on a nice downward trajectory here as of late. We're at 6.37 on the 30-year fixed. The spread is improving. The 10-year didn't improve yesterday. The spread between the 10-year and the 30-year improved. Okay, so we continue to see the spread improving at the same time that we're seeing the Fed lower the interest rates, the federal target rate. We're gonna probably hit that Wells Fargo. Maybe, I don't know. We might hit that Wells Fargo target Q2. 5.8, 5.9. That would loosen up some more inventory. Now, for buyers, it also brings more buyers into the market, potentially a lot more buyers, because it's not just those that are a one replacing one. I'm going to sell a home and I'm going to buy a home. It's all those home buyers that have been sitting on the sidelines, the first-time home buyers, those that are decided to rent for a couple of years that are coming back in. It's why I believe this winter is winters are always a huge opportunity for buyers and investors. But this might be a 6-month period when you have uncertainty across the country in a lot of different ways, not just political, but uncertainty on the economy, the recession talk, the SAMRL, all these different things that create pause. When there's consumer uncertainty, they don't take action. Oftentimes, they sit back and say, "Ooh, let me wait to see what the herd will do." Well, once the herd makes the move, now you're competing. Okay. Once you decide that you're going to go out there and attack a market like this, you might find yourself negotiating better terms, better conditions, a better deal for yourself. All right. So there's your update on where those mortgage categories are, percents of mortgage holders with a certain mortgage rate. You can grab that chart and all of the charts and obviously all of our show notes, just like this. Every day we do our show notes, make it easy for you to take this data to educate your database and the clients and folks that you're helping educate. That's all right inside of BAMX, available for you. Use code HOT to get into BAMX today, to get a discount to get into BAMX. Okay. Now let's look at typical down payments. This is also according to a new Redfin report. The typical U.S. homebuyer down payment reached a record $67,500 in June of 2024. Okay, that's a huge number. That's the typical, according to Redfin, $67,500 in June. Nearly 60% of buyers putting down more than 10% of the purchase price, and people are like, oh my God, 0% down is making such a big comeback. I don't know. I see more of this 10% down, 5% down, or more than 10%. Redfin's reporting 60% of buyers putting down nearly more than 10% of the purchase price, while all cash sales and conventional loans are dominating the market. Think about that in comparison to 2008. Conventional loans and cash sales dominate the market. What was dominating the market back in 06 and 07? It wasn't cash sales and conventional loans. Conventional loans were the rarity. They were the special item. Everybody was going with a lot of ARMs and a lot of crazy loan products that were out there at that time. Now it's really strong buyers. And what happens when the Fed puts more money into the system? Asset prices go up. There's probably more of a cash conventional loan type of atmosphere, more of what we've seen as of late. Okay. So conventional loans are dominating the market. This is a record down payment. Again, according to Redfin, this down payment, homebuyer down payment right now has hit a record high, $67,500. Previous high was back in June of 2022 at 65,000. That was right before the rates really kind of took off. Before that, I mean, you didn't see any of these numbers pre money printing machine in 2020. I mean, the highest you got since 2011 was 38,000 in 2013. And 2013, we were still in basic recovery mode. So that might have been more due to more cash coming in to acquire lower priced assets. 2012 is kind of the bottom, right? So 2012, 2013, Things, peaked out there in July of 2013, but the numbers we're seeing now, we also have never had this much money supply in the system. So it does make sense when you think about it that way. Down payment rises now to 18.6% of the purchase price. So back in 2013, it was 20%. So that shows you inflation there. That number looked like 38,000. Now it looks like 67,000. Okay. 18.6% is not a record high, but it is a high for this time period for the last 10 years, going back to 2013. Nearly 3 in 5 home buyers put down more than 10% of the purchase price in June. That's up from 56 a year earlier. Here are the reasons Redfin says that these down payments are increasing. Okay, you've got the rising home prices, so to obviously bring down, the cost of your home, you put down more money down. These elevated mortgage rates, same thing, right? I want a lower monthly payment. And then with home prices up, people who sell their previous property, so somebody who is selling and buying, they've got more equity. Yeah, what am I going to do? This money was sitting in my house before. I didn't really have anything to do with it before. It wasn't sitting in my pocket. Let me just put it back into my house. I'll just roll it into the next property. All cash purchases make up nearly a third of home sales. This is a great chart to grab out of BAMX. Okay. All cash purchases right now. This is different from how many all cash homeowners we have. That number is closer to 40%. But all cash purchases this year, it's over 30%. Okay. So buyers like getting frustrated. It's like, hey, I mean, how high do I have to go? Like if you're in that startup price range and you're competing on a property, well, how high do I got to go? They're saying there might be as many as 10 offers. Well, the odds are 3 of them are cash. Okay. Odds are 3 of them are cash. Doesn't mean that you can't compete with them. Just means that we need to base that information off of where we're going to go from here in the negotiation. Okay. Doesn't mean you can't compete. Just recognize this is what we're up against. Know who the competitor is before you go out there on the field. Do some studying, do some homework before you go and make a laughable offer that gets no response, right? A lot of buyers want to do these step-up offers or these escalating clauses when they're in that competitive situation. They want to start low and be like, I'll go really high. Come in a little stronger when you're competing against cash offers. Strength is meaningful to start a negotiation. Tell somebody you're serious. Tell somebody you want to do the deal. Conventional loans made up nearly 80% of mortgages in June. That's outstanding. That shows a lot of strength in the mortgage market right now. 79.5% conventional. FHA is 13.7%. And VA just basically riding flat where VA has been. I think that's probably a good thing. 6.7% there for VA. Really important part of the market, obviously. But you don't really see much of a difference. The biggest peak for VA was, interestingly, the first 2 months out of COVID there. May 1st, you had a peak at 9.1, but they've relatively been at 7 here, going all the way back to 6 or 7 to 2011. There's your numbers there on conventional versus FHA versus VA. Let's take a look at some of the metros here on this Redfin report. And here are the metros with the biggest increase in down payments, biggest decreases, right from the hot sheet show notes. Newark, New Jersey, up 51.1 or 51.5% on an increase in down payment. Newark is up to $125,000 on their down payment increase. Wow. Las Vegas is up to $45,000. That's up 40%. DC is up almost 40% to $76,000. The biggest decreases on down payments. Jacksonville is down 28.4% to just $28,000. Oakland's down 11%, but to $195,000 on down payments. Where's our Oakland agents at? Wow. Where's our Las Vegas agents at too, by the way? I hope you guys grabbed your BAM Mania tickets. Still available, bammania.com. But Oakland, you guys should come to BAM Mania too. Everybody should. Highest down payment percentages, San Francisco, 25.8% of the purchase price. San Jose, Anaheim, and then lowest down payment percentages, Virginia Beach at 3%. Virginia Beach is going to be a big military area where you got Norfolk, Virginia right there. You've got Newport News. Those are big military areas, so that makes sense. Detroit, Michigan, Jacksonville at 8.6. Most common all cash purchases, West Palm Beach. Why not? Okay. What do they call that? South Manhattan, West Palm Beach, Riverside, California, and Detroit, Michigan, most common all cash purchases. So the interest in there, Detroit, lowest on the down payment percentage, yet most common all cash purchase, probably investors there. Least common all cash purchases, San Jose, Seattle, Oakland, makes sense. Very expensive markets. I see Seattle is Laura's coming to BAM Mania. Seattle in the house. Seattle also least common for all cash purchases. Great market to be in. Largest increase in all cash purchases, Pittsburgh, Brunswick, and largest decrease in all cash purchases, Providence and Baltimore. Okay. We'll put all of that obviously again in the hot sheet show notes inside of BAMX, so you can grab that if you'd like. Now let's take a look at the unemployment numbers here for the week. Unemployment is obviously something paying very close attention to. Unemployment numbers have come in on a sharp increase, higher than previously expected, higher than you'd want to see if you were named Jerome Powell. Why don't you want to see? Why do you not want to see this high increase? It's because you have a dual mandate from Congress. Keep employment at a maximum level, get inflation down to 2%. Okay. That's the dual mandate. That's what they're up against. But right now, we're seeing a lot of talk about unemployment going up at such a sharp rate that it could lead to the SAM rule. And historically, a sharp rise in unemployment has coincided with a recession. Okay. Every point going back to 1980 that sees the type of sharp increase that we have right now, you see a recession that follows. Okay. So it's not me guaranteeing that a recession is coming or anything like that. It's just pointing out every point that we have a sharp increase similar to today on unemployment, we have a recession that follows. Now, there's a lot of also indicators in the market that suggest, hey, GDP is still growing. How could you be in a recession if you don't have 2 negative quarters of GDP? We haven't even seen one. We've seen downward revisions, but we haven't gone negative. So how could we start talking about revision or recession rather until we at least see 1 quarter go negative? We're not there yet. And watching unemployment is going to be a critical part to this. Okay. Is it growing? Well, in the week ending August 24th, the advanced figure for seasonally adjusted initial claims was 231. It's a decrease of 2,000 from the previous week's revised level. The previous week's level was also, though, revised up 1,000 to 232 from 2 to 233. The 4-week moving average is in line with where we just came in at 231.5, decrease of 47.50 from the previous week's revised level. So that's actually trending down a touch. Previous week's average was revised up from 250 to from 236 to 236, 250. So you see this 4-week average doing better than last week's 4-week average. So not a huge shift on unemployment. If anything, probably more of a positive for that unemployment number. And we'll obviously keep an eye on that as we get 20 days out here now from the FOMC making their next decision on what they're going to do with the federal interest rate cut. Now, yesterday, if you missed it, Wells Fargo is calling for a full point between the next 2 meetings, a half a point next meeting and a half a point in the November meeting. But CME Group has it at a 67% chance that it's only going to be a quarter point next meeting. So we got 20 days till that decision. We'll keep an eye on things and take a look. 10-year today seems to be moving up. Maybe going to hit 3.9. Look at the increase here today, this morning, going from about 383 to 387. So interesting move there on the US 10-year. Again, we saw the 30-year get back down into the 6.3s yesterday, and we'll see what happens here today with the move on the 10-year. That is your week for the hot sheet. I hope everybody has a great Labor Day weekend ahead of you. Obviously, there's still a lot of time in the year left. We're running out of it, but there's still a lot of time left to make an impact, be that agent of change. And as you prepare to close out this year and prepare for where you're going to be going into 2025, which I think we all hope is wildly different than 2024, I encourage you to grab your spot at BAM Mania. BAM X members, you get 25% off of whichever category of price that you pick on BAM Mania, whether that be the VIP for the October 17th and 18th experience or the general admission October 18th experience. Either way, BAM X members get 25% off. BAM Mania is going to be at Circa Las Vegas. Again, October 17th and 18th. Circa is practically a brand new venue. There's never been a real estate conference hosted at Circa. It is designed for how BAM rolls. If you've been to any of our virtual events, you know how we roll. We do things a little bit differently, a little more entertainment factor. This experience is not like going into your typical real estate conference. It's going to be much different than what you've seen in the past. And the venue that we chose is set up just for that. We'll be doing some cocktail parties, and whether you're general admission or VIP, you're invited to both at the Legacy Club at Circa, as well as at Stadium Swim. It's going to be an experience like no other for the real estate and agents of change community. Grab your tickets today, bammania.com, and BAMX members, remember, you get your 25% off. Have a great weekend, folks. It's been a pleasure to bring you this week's hot sheet, and I will see you after the holiday back Tuesday, live, 9:30 on the East, 6:30 on the West, and you know the deal in between. Until then, toodaloo.